Hi guys, my name is Ang Tang with Tozy Capital. I'm very excited today to present our latest multifamily real estate deal. It's something that for those who have been following our journey, we haven't had many of these in the past year. In fact, the past 6 months, it's really been a drought. It's been a lot of close calls and near misses. And a lot of the offerings that we've seen in multifamily has been really great. It's done really, as an asset class, done really well. I like this one because it was also part of a near miss for us. And so I'm going to go through this presentation. Hopefully it'll take less than 30 minutes. Mark will be going into a lot more detail on the property as he's been closer to the operations team. And just as a reminder, this is a confidential offering. Feel free to let us know if you want to refer anybody, but just let us know, please. There's a lot more bullet points than you think. It's not that many pages, but we're going to go to the investment overview, the business plan, the terms, the cash flow, the financial summary, and then really go into the location and why I think this is a great opportunity, and then go into the property and go into our experience and highlight a little bit of sensitivity analysis for you guys. So the Regard is a multifamily investment offering comprising of a 319 unit building, 2013 vintage. So it's newer vintage, but it's mismanaged. It's a Class A neighborhood. Rent per square foot is 41% greater than the Regard's rents. So that means there's a lot of potential upside here if we can get to those our neighbors' rents. It's a light value add update, which means that there's not going to be that much complexity to this deal. We're buying it at a very great price. We're partnering with Frankfurter Group, who we partnered in our last multifamily deal, and they're proven experts and sponsors, and they were the one who were able to secure this great deal. And they have 8,500 combined, 8,500 units under management. And we're implementing best leasing strategies with Greystar Property Management, which have over 70,000 units under management. I've been to Texas a lot. Some of that's been for Bitcoin mining. Some of it's been for looking at deals with Mark. And I think Houston's one of these fast growing markets that obviously the pandemic and commodity prices have really heightened the value of oil, which is something that Tozy Capital has also invested in. But Houston is using those tailwinds. And I think there's going to be a lot of great opportunity in this specific location. Mark, I think this business plan is pretty easy. I just see a lot of low-hanging fruits here. Can you walk us through this strategy for the Regard?
Yeah, this is one that we're not going to overcomplicate. The fact is the comps, especially the neighbor where we want to be, they all have higher rents than us. This is a relatively new property and with a 2013 vintage. So it's great. We don't have to do a bunch of crazy renovation. The pipes aren't going to be bursting in the wintertime when it freezes. This should be a light lift. So in essence, what did happen was it was mismanaged. And if you just look at the current existing payroll, they're underpaying to get people who work there who aren't good enough. And so what we're going to do is hire better people and maybe add another couple positions so that we can have the quality, a Class A quality of sales team that can sell to the market that we want to sell to. And then the common areas can use a little sprucing up. There's 3 courtyards. There's a pool that has good bones, but we can make it nicer. And then there's 2 very underutilized, good-sized common areas outside that we'll be able to make a lot nicer and similar to what our competition has. Like I said, there's the comps have much higher rent. We'll just do a little bit of touch up, add some tech package, and then increase some of the amenities. And we think we can pretty quickly catch up on rent, or at least even just getting close to our competitors' rents does very well for us.
Yeah, there's a lot of table stakes here that isn't being implemented at all. And a lot of that is because the owner isn't really managing it a lot. They're not managing it well. So they're not focused on it. And I think when we were secret shopping our competitors as well as the Regard, we clearly saw a big difference. But the location is very similar. The location is actually in Regard, I think, much better. And I think that for 2013 vintage, is not much foundational effort here. It's more about the experience and creating these amenities, which our competitors have.
Yeah, I saw a question come in about more detail on the mismanagement. When I first went to secret shop it a couple weeks ago, I went to the front door and there was a sign on it that said, closed, come back in an hour. I did. I went right across the street to the competitor and I would have signed that lease if I was a legitimate, not secret shopping. But when I did come back, there were 4 people inside and the door was still locked, so they didn't unlock it properly. And right off the bat, that's a horrible thing to do, to close your doors during a prime leasing hour. The place could have been kept up better. There was trash in the hallways. It's the salesperson, they didn't make a connection. And if I'm someone who's working in the med center or one of these tech hubs close by or downtown, it wasn't a good fit for the sales team and our target market.
Mm-hmm. What does this business plan get us? It gets us pretty good results because it's a very undervalued property. We're basically buying below replacement costs. Our year 1, 2 cash and cash isn't our typical very high, but it's still 5.6% in a very nice market. The multiple is 1.6x targeted multiple, and our target IRR is 18%. It's going to be a 8% preferred return for those who are familiar with what that means or familiar with multifamily deals. Essentially means you will receive an 8% return on your invested capital before the sponsors receive anything. And then above the 8%, no catch up. There is a 70-30 split, 70% to investors, 30% to sponsors, only until you receive the 8% return. And we're targeting a 3-year hold period, allowing us to really quickly adapt our business plan and take it to market rate and potentially look for an opportunity.
And quick interruption there. One of our investors asks the following question. For new property investors, kindly review ARR and IRR. I'm not sure if they're saying what is the IRR for this particular investment, or they're asking, can you define IRR and just tell me what it means?
Yeah. So Mark, you're an accountant. I was in finance. IRR is really a function of your velocity of capital. I've always talked about what investing really means is about optimizing capital. And optimizing capital is shifting money from the future to the present, is allowing you to compound your money faster. And IRR is a measure of how quickly you return your capital and how much you return your capital. AAR is average annual return. So in this investor cash flow target model, you're essentially seeing 160% return over 3 years. So take that 100% out because that's your money. 61% is your 3-year return. And if you want to calculate AAR, just divide by the number of years. So that would be 20% AAR. Our target is 20% average annual returns for an investor, and IRR is around 18%, which just highlights sort of the acceleration of that capital. Providing quarterly distributions starting in Q3.
I'll let you go ahead with your presentation and the questions can come in a little later.
Okay. And I think this is a lot of the meat of the presentation, the financial summary. I don't want to get too stuck in this. Feel free to ask any questions here. And of course, this deck will be available as well as the pro forma for you guys, if you guys want to dig deep into the numbers. Essentially, we're buying the project at $65 million. We actually started at a little bit higher than that, $68 million. And so we were able to get it, reduce it a little bit further to our below market expectations. We're finalizing the loan. And of course, folks might have heard that interest rates have gone up. So we are doing a 3-year bridge loan as interest only, with a one point cap on that. So we'll have some security on if interest rates increase. The co-sponsor team, including the Frankfurter Group, will be adding 10% of the equity, and likely will be a little bit more. So this nets us a 1.6x investor multiple, as I said, 18% investor IR, and 20% average annual return for investors. I want to really go into I want to highlight what this project looks like. It's on the water and it's a very interesting location. That's the Regard. Next door is the Aspire at 610. It's a newly built, I think it's 2020, right? And newly acquired property that our partners were very close to acquiring. We actually made a bid on it, and we were outbid, and that's okay. We don't want to we don't want to throw money out at things that might not make sense. But we love the neighborhood. We love this potential area. And really, when you look at the Aspire 610, it's a Class A complex right across the street. I think our location is actually better because of the water feature we have. It sold a couple months ago, and we were missed out on it. But because we developed a great relationship going through this process, we were able to get a deal in with the broker, who's great friends with the seller. In fact, the seller is paying the broker for the fees in this case. And we get great first dibs and take it off market. So the Aspire sold as $240K a door, and we're getting it at $204 a door. So significant discount compared to the Aspire, and a lot of potential opportunity upside as well, because it's just right next door. And I want to highlight some of the rent comparables just to even highlight even further. Our current in-place rent per square foot is $1.63. Our target year one is $1.89. Aspire was $2.30. And the average of our comparables nearby within a 1 mile radius of the project is $2.30. So we are well behind in comparables. And with just a few fixes to the project, to the customer experience of the renters, we believe we can increase to market rate. And our projections aren't even to market rate, it's just below that still. So I just want to highlight again where this location is. It's right next to Energy Stadium. It's right next to Aspire, a project that we tried to buy. It's next to all these other great locations that are much higher in rent, but not necessarily a much better location. It's in fact, we're all kind of in a very similar kind of location. And we have great access to the freeway, 610 freeway, which is in Houston, a lot of traffic, but without traffic, probably 15, 20 minutes from downtown. So I'm not from Houston, but I think buying in any place, you always want to make sure that you have population growth, job growth, and crime decrease. Mark lives in Dallas, and he can speak a little bit more to why Houston and some of his projects that has done really well in Houston and why Houston is a great project.
Yeah, so Houston is this dynamic market. It's an extension of Texas. You know, initially, it was a big oil and gas town. It definitely made its name that way. You're familiar with NASA, which has the Johnson Space Center down there, very close by in Houston. And this property is just uniquely positioned. It's right by the Astrodome and now the NRG Stadium. But within 2 miles, you have the Texas Med Center, which is world-renowned. A couple of the locations, we'll talk more detail about this shortly, that there's a ton of jobs right there, great paying jobs, especially lately with the labor shortage. So that is 2 miles away. And then it's a magnet for new companies. So they've diversified significantly from the oil and gas. If right now it's great, oil and gas doing well, so that's some great tailwinds. But even without that, you still have a lot of high tech moving into Houston. HP recently relocated there, as well as other smaller companies. Texas is just very business friendly. I'm from Los Angeles, like many of you, and been here in Dallas for, 16 years or so. I'm starting to lose count. And I can't move back. It's too easy to live here. and to do business here. So we're going to keep seeing that influx. The workforce is highly educated. There's a few universities right there in Houston, but like Dallas, we attract people from other universities. Texas A&M is there, close by. Baylor's in between Dallas and Houston. You get a lot of folks from Oklahoma, OU, and Oklahoma State. Yeah, it's great. Houston is a great.
It would be probably second on my list to move to in Texas. If I could convince my parents to move to Texas. It's very hard to move out of California, even though taxes. And
I'm still partial to Dallas, but
I just see who was the number one. I want to highlight again this great potential location because it has a lot of, for those who've heard of the phrase path to progress, that means there's going to be a lot of potential development, or in this case, actual development that's already planned. You can read up on these developments. Right next door is Energy Stadium, right north to 610. We're only a couple miles from downtown, but we're also importantly next to the Texas Medical Center, a world-renowned center of higher education, medical research, and soon to be more commercial activity through a $3 billion upcoming development. And then right south of that is Texas University is planning a $200 million build out of additional campus space. So we're well suited to be capturing jobs that can't really be work from home, right? These jobs are service jobs, and these places are serve the best type of renters.
Actually, that last slide, it's University of Texas, not Texas University.
Okay.
And so UT Austin, UT Dallas are very big schools, and there's not a big presence unless you're in the medical field for the UT system in Houston. So this is actually a huge development, and it will be really great for Houston, especially us in close proximity.
Yeah, and now you guys get why it's called Regard Ed Med Center. And speaking of the Med Center, I just want to highlight in brief that this is going to be a very big deal. Not only is it already attracting a lot of jobs, it's creating a lot of new additional employment, which if you look at real estate, you want employment, you want higher educated employment, and that's coming, and that's already has happened. And so I think if we didn't do anything with this project, just the natural growth of the local area, local population, local demographic, I think that would create a lot of tailwind for this investment.
I'd also like to highlight, so MD Anderson is the preeminent cancer center in the world. You have people flying in from all over the US and the world to go there. And Memorial Hermann is also world-renowned, very popular.
Yeah. And the Regard Med Center is going to try to cater to this audience. I think there's going to be a lot of really clever things that we can do, knowing who our target demographic is, as that demographic expands and gravitates towards this local region. I believe it's a beautiful property on the outside. It's got great bones. There could be some improvement. Mark, you visited, there's a lot of space in the courtyards. There could be some more. I know that when we were cigarette shopping, they were telling us that there's gonna be some stuff here and there being improved. As in, I think they got wind of that they're getting sold, right?
But I don't think they did, but I do know that there's been enough grumbling that the amenities are crap and they're across the street. Neighbors are already nice and shiny, and they're going to get even nicer and shinier. I think that's all that was.
Yeah. And why do we keep talking negatively about this property? I think it's all about opportunity. Where is the opportunity? An investment in amenities and increasing the rent to potential market creates a lot of ROI, a lot of investment opportunity. And the amenities could use some work. But I think it's a beautiful property, 2013 vintage, as I said. The units are actually very spacious compared to the local other 1 bedrooms and 2 bedrooms. And I do think that there could be a little bit better. I think the model units could have stainless steel appliances and the upgraded laundry. There's a little bit here and there that seems off for this class and this type of property. And for folks who have the energy, the sponsor team who have the energy and the experience to do so, I think there's a lot of great upside here.
Yeah, this is great. Like it already has crown moldings, which is a Class A feature. So they spent the money on it, but then with the stainless steel appliances and a black unmatching stove, you can see there in the top left, you're kind of cutting yourself short there. It's those fine touches that are missing here that they're really doing themselves a disservice. And in fact, when we first started looking at this, rents decreased a little bit because of the condition of the deferred maintenance and then missing out when the market is getting nicer and these guys still have some minor things that weren't attended to.
Mm-hmm. That wasn't on purpose. And so to just reintroduce our team, we got myself, Mark Vinny, who is coming on as a capital partner, and then Yakov, who is the operational partner. And we're partnering with Yakov and Frankfurter Group for the second time since the last deal in Maple Haven. And I want to highlight their experience because they will be primarily the asset managers alongside Mark, and they have a tremendous amount of experience in 8,500 units, and they've had some recent pretty good full cycle cases as well. And of course, it's all going to be about turning the project around. Greystar has a lot of great experience in this location, in this general area, as well as in these type of projects or properties. And Mark did a really great job at some sensitive analysis. When we received some of the underwriting and we then validated and checked it and we worked on it ourselves, we wanted to be a little more conservative. And so the gray represents where we are in our underwriting. And of course, we'll have those pro forma in the offering room. But the yellow really highlights where the operations team, the guys who've been trying to buy Aspire alongside with us and have been knocking on the doors and checking all the data. They believe that the new release rental rates over time will be 481 above current rent. We're knocking that down by 100, and we feel very strongly that's very achievable, and that their more optimistic forecast is also very achievable, especially with macro trends providing some great tailwinds for Houston and the specific location near the Med Center. And I know folks will be asking about interest rates. Our current interest rate is 4.85. We will have a 1-point cap. And to the extent that why this is a 3-year bridge loan, this is a 3-year project. And I know somebody's asking why hold it for 3 years? Because that's where a lot of the value comes from. We're going to turn this around and create market rents. We're going to lose the loss. We can essentially get closer to our competitors. We're not projecting to be above our competitors. We're just getting to market and to closer. So our interest rates being 4.85, it doesn't really, because there's so much opportunity upside here, I think there's so much great value still. And then our exit cap rate, we're targeting a 4.5. That's generally not the sell cap of this area. And we believe that could be lower in a more compressed market. And then on our vacancy, generally these type of projects in this type of population generally have very low vacancy. We're forecasting 5% once stabilized, although over the first year, we'll have a little bit higher vacancy as we turn over units. So what's the timeline? We're opening the investment today. We'll likely have, can't promise, but likely have the docs to sign tomorrow. I know our team is hard at work on it as we speak. Funding deadline is June 6th. We're working on finalizing, closing the loan. It's a race against the clock because we want to make sure that the interest rates don't rise too much during this period of time. So we're closing property on June 10th, and we'll have first distributions for Q3 in the following month. And then we'll provide K1s to you guys on March 2023. For Maple Haven, the project that we partner with, we did provide K1s in March as well. And just to get into some quick FAQs, I know we'll have a lot of questions. This is a 506C. Unfortunately, we won't be accept non-accredited investors. We will be accepting self-directed IRAs, but we won't be able to accommodate for 1031 exchanges. Although we have helped several people with 1031 exchanges and other projects, we just need a little more advance notice, just giving a little bit tighter timeline. Real estate is not a typically illiquid investment. That generally is why you get to see such outsized returns because liquid investments generally command higher premium. But so I wouldn't expect that. First dividend check would be a quarterly check in essentially for the Q3 operation in October. And minimum investment is 100K. And then we'll have a deadline subscription in end of May. And then Mark will be providing updates on a quarterly basis to investors. And then we'll close the project on June 10th. And then just to highlight for those who don't know, bonus depreciation does allow us to get 100% of any property that has 5 to 10, 15 years shelf life. We probably deem around 20 to 30, 20, 25% of the project to have that shelf life, which allows us to essentially accelerate it to 100%. This accelerated bonus depreciation will probably only last this year. Next year, I believe, is going down to 80%. So buying property, investing in projects for 100% bonus depreciation, not saying that you receive 100% bonus depreciation, but we would expect probably close to 40 to 50% of your investment basis as a K1 loss, paper loss, helping you offset other passive income gains. And then finally, we do expect to invest more than 10% of the equity, and depending on how many investors we have. With that, I'll hand off to Shiv to ask us any questions.
Awesome. Thank you so much for trying to compress all that in 30 minutes. So we'll start off with some questions. I know most of the initial questions, which I would call very fact-based questions or numbers-based, date-based, and so on, have been answered during the presentation itself, but it doesn't hurt to actually go through that once more. An investor is asking, what will be the payment strategy for investors? And I guess it's a quarterly distribution followed by an exit that's being hope for an exit at 3 years is what it is, right?
Yep.
Mark, a couple of follow-ups from your initial observation. What made you check out that building? Was it up for sale? But I think you have covered it, but I would love to hear the story behind how this happened.
Yeah, we were looking at the Spire at 610 across the street, and Eng did explain this earlier, but happy to repeat. We were outbid, and being outbid is unfortunate, but at least that means we're not overpaying for that property. We formed a great relationship with the broker, and we identified this property across the street as a great target. So we then started engaging directly with this property owner who has been in the property since inception. And it turns out the broker went to school with the seller, and so they have a great relationship too. So it took several months of convincing to work on them, convince them that it was time to sell. They did have some partners in that deal who they've all been in it for a while, and some of the partners were older and I guess for whatever reason were ready to entertain sale. So sure enough, after working on them for a few months, we were able to convince them and still get it for a really great price.
Thanks, Mark. Mark, you talked about an initial problem of mismanagement. An investor asked, isn't that a very easy and small problem to fix? It could just be fixed by getting a more responsible crew. Why is the seller letting go of a recently aged property that's in a high demand market for this reason, that too below the replacement cost?
Yeah, mismanagement is a people problem. You're absolutely right. You can spend more and hire better people. That's part of it, but you also need the right people. You need a good culture to attract those people along with paying them a fair wage. And I think what happened here was the seller, they were just trying to save money where they could because they're not charging market rents. So that creates a lot of pressure. So to save money, they hired people, I don't want to call them cheap, the less expensive people to fill those positions in. And in this case, it was the wrong decision. So
You guys should think about it this way. Like, if you have had a house for a while and you rent it out, over time, you made a lot of money. Your investment basis was very low. Now your cash is very high. And you get, you settle for not raising the rents here, not providing this and that, because it's still providing you a lot of great cash flow. Your investment basis, your buying basis is probably low. So just in general, happens time to time. That's why when you buy, you have new owners who are looking at this as with a higher cost basis and trying to create strong investment returns. You're just going to find more energy, and that's okay. The owner is a bit older as well, and so he's going to make a lot of money from this deal and leave a lot of meat on the bones for us.
Awesome. Thanks, guys. So to all the investors and folks who have joined, we have 33 questions. I'll just try to group them in the order in which they came and group together similar questions. So please be patient before your questions comes, and we'll definitely make sure we answer all the questions before we end the webinar. Just a couple of observations. A few participants are raising their hand. In a typical Zoom meeting, you would then be able to ask the questions. Unfortunately, this is a webinar. So if you were raising your hand with an intent of asking a question, please do ask the question using the Q&A feature, and I'll definitely ask the question on your behalf, and we can have as many follow-ups as you want. To an investor asking, when will this recording come out? Mostly I've seen Eng's team publishing the recording immediately tonight. Worst case in case there is a Zoom transcoding issue, tomorrow morning. It'll also be available for you to watch in the portal itself, which is the second part of your question. How does an investor subscribe? You will be getting the email. You can log into the portal. It's free there's no charge for logging into the portal. You should be able to see this investment as an investment in which you can invest in. And Eng said maybe tomorrow, as soon as the subscription docs are available, you would typically peruse all the documents, sign the subscription docs, and then fund the investments all through the portal. Of course, the funding happens either through a wire or a check that happens out of band from the portal. I hope that answers your question. Did I capture that correctly, Eng?
Yeah, and I'm going to put the link to that offering page if you guys want to check it out. It's not filled out yet. We'll probably put the recording in there.
Yeah, so just bookmark the link that Eng has just shared on chat, and it will be populated with all of the documents and the recording that will be added to that. To the investor who asked, just on top of your comment is the link to the portal. And if you're a first-time user, you'll just need to sign up to the portal.
I think I got a message that said it was posted to hosts and panelists. I don't know if it went to everybody.
Oh, sorry.
Oh, okay. Sorry about that. Let me take care of that. Why don't we? Okay, thanks. Yeah. All right. Again, I would request people to ask the questions using the Q&A features, but don't worry. As soon as the questions are answered live, you will be able to see the questions as an answered question as well. A few investors are asking why this restriction on exit in 3 years. The questions are coming in all forms. Why 3 years? Should we definitely sell after 3 years? If it's a great performing property, why shouldn't we hold after 3 years? Can you talk about the exit strategy?
Well, part of the exit strategy would definitely be to take advantage of either better opportunities, or if there's no better opportunities, to take advantage of potentially better capital market conditions, whether it's through a longer term refinance, through a more stable, lower interest rate loan, and potentially capitalizing and providing a fairly healthy return of capital to investors. Our partners believe that a 3-year strategy provides the highest IRR. I tend to agree with them here. But in the case that there's no great properties to buy alternatively, or because obviously there'll be a pretty significant capital gains tax, that would be something we would evaluate. But for now, we're planning a 3-year hold. And
do we have a 6-month report of lease applications received for this community? How's the lease up rate, and do you have the report on the lease up over the last 6 months, trailing 6 months?
Sorry, I shouldn't have been reading a second question at the same time, but the current occupancy is 88%. And then we do have steady lease up over the next, over the next 2.5 years. We're going to have current lease lessors renewing at $125 per month more than what they're currently paying, while new people come in at 381 or more. It's a process. We're not going to jack up rents too much on people who are already living there because we do like the occupancy. It also leaves some meat on the bone so that when we do sell it in 3 years, there is upside, so we'll have a quick sale when it's time to sell it.
Okay. You talked about depreciation. How much depreciation are you going to capture during the third year? I'm not sure. Did you get that question?
I guess like the question is more after you take all this bonus depreciation that you can't use anymore. And yes, we will do a cost segregation study. And yes, we'll accelerate that 5 to 15-year life of property that's within the building. And that should constitute around 20 to 25% of the building. That's been my experience for these type of projects. And then minus land. So that's with adding on essentially 71% LTV loan, which does not share in depreciation. The investors would take an outsized portion of that depreciation. So the first year could look like a negative 40 to 50%, potentially more, first year K1 loss. Subsequent years, that will be depleted, but you still have 80% of depreciation being written off in a 27.5-year life. So for anything above 15-year life cycle, which is the majority of the project, would potentially, we can accelerate that. And we'll take that in 27.5 years. So typically I would expect around 4 to 5% depreciation of your investment value in the subsequent years.
Thanks, Hank. An investor asks, how is this deal and the returns in this deal compared to the senior living deal that you have?
So if you compare it to the most recent senior living deal, and thanks for asking that, which is still open, we funded already, that's a fixed income deal. That's fixed returns, that's pref equity. There's no potential upside, but that also means on the inverse, less potential downside. Not saying this downside here. This is a profit sharing venture, be providing full transparency on the financials because we're sharing the profits and you're sharing in comparing it. It's mostly, it's gonna be generally lower cash flow, potentially higher upside on the exit. You're betting on the market, betting on that profit share versus the senior living investments, which we've had many investors join getting 12%, average yearly returns, 1% a month, very high returns. So it just, for different types of investors who want cash flow or higher returns, there's different projects for each one. I really do like diversification. Senior living generally does have higher NOIs, higher cash flow. Mark, you're very familiar with senior living. It's just that the structures of those previous deals have not been the same as this one. So it's just different investment structures specifically.
Thanks. And is the investor investing directly in the property or a fund?
The investor is investing in an LP, and we're using LP because our partners are Canadian, and there's some tax reasons for that. It doesn't.
It's not taxation problem, right?
Versus an LLC. But structurally, it's very similar. Tax efficiency for investors is the same. And then that will be essentially that LP will be investing into owning the PropCo. So you're not investing into a fund, you're investing into all investors in this deal, including the sponsors will be investing into that one LP.
Thank you. And just to put on my investor hat on, this is how almost all multifamily deals are done, right? Where the investor is investing in an LLC or an LP, which is the Investco, which actually then is putting the capital into a PropCo that's holding the property. It's as normal as it gets.
And part of that also allows us to potentially tender exchange at the LP, the Investco level. So the Investco, which have all of us as partners, in event of a very sizable capital exit, which planning on, we'll probably have a very high tax burden. And we would try to find another project that will potentially allow us to enter exchange into, and partners can ride along with it because they essentially are part of the LP, or they can be redeemed out. So there's that optionality for investors.
Thanks, Hank. What is the projected exit cap rate? You did talk about that, and the purchase cap rate, if you can just quickly.
The exit cap rate is 4.5. The entry cap rate is 3.8 on in-place rents.
Okay. And if the numbers are just flying quick and fast, there will be a recording of this that's available for everybody. And of course, the slides will be made available on the portal as well. Thanks, Eng. It is a 17% discount, as you called it, but you'll be spending close to 10 million on CapEx, which gets the per door price at 235K, which then becomes closer to Aspire. Are you not worried that at that price, it will be closer to Aspire, which is a 2020, much more newly built?
There's two components to that. One is our units are generally bigger than Aspire. That's a newer build project that they're trying to maximize their unit counts, and they have more limited space, and obviously materials. It's been expensive the last 2 years to build. The second is Aspire is also doing a lot of renovation too. It's not like they're not putting a lot of capex into meeting market demand, because those renovations create higher potential rent. Because we all see what's happening in this location. $3 billion of development in a very high income sector of the economy, medical and medical research, is imminent and happening. And so we want to rise to that level of our potential. We want to rise to the level of the potential economic demographic that will exist around this area. So it would be foolish to not put any investment for any new property, or for us.
Thanks, Hank.
I'd like to add on to that, actually.
Sure.
So to be clear, actually only 2 million of that, or 1.9 million, is CapEx. The rest are different types of closing costs. And first, that's a great question, very well thought through. To Eng's point, the Aspire 610 probably also had a similar amount of closing costs and also the CapEx that Eng mentioned. So both of them, you got to increase by that.
Thanks. We're getting close to the top of the hour. We still have 38 questions. So just to let first-time investors or first-time attendees to Tozi Capital webinars, we'll keep going till all the questions are answered. So if you've asked a question, we'll definitely be answering that. An investor asks, aren't you concerned with the 88% occupancy? That seems low considering, and the property seems to be having the lowest rent when compared to its neighboring ones. Isn't that a concern? I think you have talked about it. Do you want to add anything specific on that?
It's usually a spiral one direction or another. So in this case, they spiraled down. The pandemic did not help them. So we'll come in, we'll clean ship, we'll change out the people, we'll refreshen it. So the 88% is actually a big favor to us, because if it was 95% or more, the deal might not work for us.
Thank you. The slightly lateral question, checking if we have performance of Mark's previous projects that Tozi Capital invested or marketed to its investors. I'm not sure what that means. Mark is part of Tozi. Are we just talking about previous Tozi projects that Mark was also involved in? That's how I take the question.
I think probably referring to, I would guess, our partners, assuming that Mark wasn't a partner, not a member of Tozi. And so, yes, we do have some deal level returns that we highlighted in one of the slides, and they've been pretty good. I think in general, you can see my screen here. Our partners have had some exits, and right now they're actually in the middle of exiting 2 deals in the next 2 months that will likely have close to 30+% IRR.
Yeah, another version of this, I think it's been answered, so I'll probably come back to that. Is this a Class A property? I think that's been answered. It is a Class A property is what you mentioned, right, Eng?
Yeah, me and Mark debate this. From the outside and from what Aspire is and what the other projects are, they are Class A. I think from an experience perspective, from the inside, I think you're probably looking at more like a Class B plus. I think the neighborhood is definitely going to grow into Class A. That's why there's Class A buildings being built in the neighborhood, being developed and being renovated. And so we want to aspire to that level.
Okay. An investor asks, is there a contingency fund or emergency fund in place? That's part one of the question. And at what occupancy dip would the emergency fund needed to be utilized?
Yeah, so we have 500,000 in working capital. So Part of that is going to go towards.
It's actually 880,000 according to that budget.
Yeah, sorry. I was going to split it up a little more.
Oh yeah, split up, yeah.
There's, in addition, we have an extra 500,000 just for a rainy day, so that if there is any issues, we don't have to worry about how we're going to fund that. And then we have some additional contingencies in there as well. And let's see, there's 200,000 for concessions and a marketing reserve, which I just don't see us going. Maybe we use 50 of that. And then in addition, we have another 90,000 additional working capital.
Mhm.
I guess we could have combined that.
Yeah, and the break even is 20. Mark forecasted a 20% vacancy break even based on a conservative underwriting. It could be a little bit higher potentially in terms of the flexibility of that. I know investor asked the question of why our vacancy is considering if 88%. Really think about the demographic. Who's looking for apartments? Who's looking for housing in this area? It's not folks trying to find the lowest cost place. It's folks who are in the medical profession, in the research profession, in higher education or studying in higher education, and they have resources. They have resources to spend on living. And in this area, right next to, right across the street, you're seeing rents $200 to $400 higher, and significantly higher on a price per square foot basis. So again, it's if you have a place that is very cheap and has low rents, but isn't to the quality of your expected demographic, you should expect lower vacancy. So what we're trying to do here is create a business plan that allows us to rise to that expectations of this community and provide them great housing and really increase our market rents.
And you mentioned that 100K is the minimum investment, and an investor asks, is 25K investment a possibility?
We will generally provide some exceptions. I think one of the challenges is this is a very sizable equity raise, and we want to keep our total LP investment to 99. So we would likely prioritize higher investments.
Let me put on my investor hat and give you an input to the investor who asked the question. The best way is to definitely reach out to Ryan or Tozy and make your case. But like I said, if they have this constraint on 506 and the limitation, that could be, but you should definitely hit them up with an email. I've done that before. An investor asks, if I invest 100K, even if the real estate falls, would I still get 161K after 3 years?
I think if you're looking at the senior living investments where we have essentially our capital essentially being not pari passu, but above at a higher risk quadrant to your preferred equity capital, if real estate falls there, we would essentially be going to zero and the investors could still receive their returns. So in this case, it's not structured like that. That's why there's that 70-30% profit share, still 8% pref to investors. There's no guarantee in any investment. Can I do as much research and make as much well-educated decision as possible? I think investing now is still a very great opportunity in a market, and having cash sitting in the sidelines over the long run, it just doesn't work out.
Okay, thank you so much. We are at the top of the hour. So to all investors who had just budgeted an hour, thank you so much for joining. It'll be awesome if you can just stay back because we have 33 more questions and we'll definitely go through all of them.
But we just had 33 questions.
If you have to drop off, then thank you so much. You will definitely get a link to the recording where you can start off from at the end of the 1 hour and continue watching. And can investments be made through LLCs?
Yes.
Okay. Mark, who among the sponsors will have their boots on the ground at the property?
Yeah, our JV partners will be there often, at least monthly. I talk to our JV partners often. It'll start out with weekly conversations, and as things do very well, that'll slow down a bit. But with our other property with them, Maple Haven, which is now Stanton Yards in Atlanta, we talk often. My input. It's a great working relationship. We challenge each other. They take my input and use it very constructively. When we look at who we want to partner with going forward, we're very selective of who that is. stuff that was prior to my being at Tozy, I'll leave that there. But with these guys, they are top-notch, great JV partners for us, and we're very much looking forward to working with them on this.
Okay. I think that sort of answers who's the asset manager for this property. It's like the previous one, it's jointly asset managed by our JVs and you, Mark. Is that correct?
Correct. Yeah, and I go to Houston pretty often, and so anytime I'm in the city, I swing by. Same with Atlanta. I won't put a number on it, but I'll be there relatively often.
Okay, I'm seeing investors are dropping off, so I'll try to get the more interesting or more pertinent questions bubbled up. There are questions like, what is a K1? I think I'll hold off on asking that question till the end because it's something that I want to ask the questions that the maximum number of investors can actually take benefit from. Do we get any tax benefits to avoid paying tax for the annual returns we get?
Yeah, I guess to avoid or defer is really name of the game, right? Can you keep more of your money, meaning that we're paying you guys 5%? And on paper, when you file taxes, because we're not withholding any taxes from your distributions, like income would do, on paper, it'll look like a negative 40% to 50% loss for that for the first year. So you'll have that loss, and you can use it for other projects or other K1s that you invested in, or you can use it for future income that's generated from this project.
What would be the bridge loan interest rate? I think we did touch upon the interest rate, right?
Yeah, 4.85%.
Okay. Can you please show or talk about the pro forma and assumptions?
We do have the pro forma. We'll provide that in the offering room. I think that would be too long to show in depth though.
Okay, Mark, maybe you can just make a note of it. I think you can see the investor who's asked the question, right? To that investor, the pro forma EngSays will be uploaded to the portal and you can download it and take a look at it. But then
I think if there's enough investor interest, I'm happy to host a separate
follow-up
session with Mark leading the pro forma deep dive.
Okay, you guys heard it. If there's enough interest and if you want to hit Eng or Ryan up and say, hey, we want to have a webinar or a Zoom session to walk through the pro forma, I think that can be happen. Otherwise, the pro forma will be available for download on the portal. Can you walk us through the tax liability for the 3 years? What would be the tax liability over the 3 years, assuming it's a 3-year exit?
Assuming you don't use the K1 losses for any other investments, which you should, because that's a great IRR play, you would essentially have that just if it's 61%, you just have the 61%, because any losses that you bank now, essentially use it for the future. Depreciation is just a reduction of cost basis. It's a borrowing of profits, it's borrowing of taxes over time or deferred taxes over time. So if we bought it for $65 million and then we sold it for $80 million and we took a $15 million depreciation benefit and passed it to investors, whether you use it or not, our cost basis now would be $50 million, and that capital gains would be the difference of that sale price versus 50. Although that depreciation recapture rate is at 25%, I believe, or 20%. It's a little bit higher than long-term capital gains rate.
Okay, sorry, I was just looking at the other questions. Would we be able to 1031 exchange during exit?
Yes, so that's the plan for this investment. The LP will be able to, the limited partnership, not the limited partners, the limited partnership would plan to identify a strategic investment, enter a change into it, defer the whole gains for the LP, the partnership, but partners themselves can opt out of that and can be, get that full return and pay taxes as you like.
Is there a separate asset management fee to Tozy?
No, we're sharing the asset management fee, much smaller percentage.
Thank you. What are the current fees? I don't remember seeing this in the presentation.
It is in the financial summary, but just to highlight, it is a 2.5% acquisition fee, 1.5% loan guarantee fee, and a 2% asset management fee on gross rents, and a 2.5% property management fee. So really, because we're doing a lot more in the property management side, and that's why the property management fee is lower than you expect. And so you bake that to essentially a total of 4.5% property/asset management fee, which shares between Greystar and Frankfurt.
Mark, is the property outside the flood zone?
You know,
Yeah, I don't know the exact rating, so let me get that answer. But if I remember correctly, this did not have any flooding in Harvey. So yeah, actually, sorry, I worked through it in my mind. Yeah, this is outside the flood zone.
Okay. Would in-unit renovations require occupants to vacate, and would it be on a rolling basis? Would management be required to compensate the tenant if they have to vacate?
With a 3-year hold, we're not going to have to do that. There will be enough between our 125 a month rent increases for renewals. Not everyone will renew. And so when they don't, that'll be our opportunity to go in and make that upgrade. But if we were holding this longer, we could, potentially do that. But generally what you'll find is people chose that place at that rent level, and they're not, if they wanted nicer, they would have gone somewhere nicer and paid that rent.
Thanks, Mark. How has Maple Haven, and for new investors, Maple Haven, what is called as Stanton Yards, is the previous multifamily deal to this one. And Mark, how has Maple Haven performed relative to projections? And are there any recent lessons that are being applied to this property from there?
Maple Haven is a little off. It's not quite where we expected it to be because there's some outside forces that are getting in the way. Sorry, Shiv, I think
I muted him.
Okay. So yeah, on that one, we are engaging an attorney to sue the city because they're taking too long to evict people. And they're also, we were 9 months in and they still haven't approved our plan on down units. So by suing the city, we don't think we'll actually go to court. It's just going to wake them up and say, okay, we got to move a little quicker with this group to avoid problems. That has slowed us down, but for what we do have under our control, we've been able to exceed our projected rent, despite still having people in there who we should evict and are not able to. So you can interpret it both ways, but again, we're very happy with the progress despite those headwinds.
And we have been paying investors 2 projections, and would likely have, and would likely continue to do so.
Sorry about that, guys. Just had to close the curtain. The property next door that we were looking at, Aspire, will also most probably be sold in 3 years. At that time, wouldn't that become a competitor to our business plan? In regret, I think they meant regard. I hope it's not called regret.
Yeah. So on one hand, often you'll see it sold in 5 years. So I don't think it'll be competition. But if it does sell at the same time, it actually works in our favor because what'll happen is one buyer will come in and try and take both. Ours becomes more valuable to the buyer of that other property. We'll cross our fingers, but that does happen, but it may not happen.
An investor asks, can you go over the equity distribution again after the 3rd year? What happens after the 3rd year? I think they're talking about the LPGP split.
Like visually show it, or
you can just go over the numbers.
Yeah, so it's an 8% preferred return. Hopefully that's what you're asking. It's 8% preferred return, annual cumulative non-compounding. So essentially, if we're paying investors 5% the first year, we owe you 8%. We need to now pay you 8 plus 3%. That's a net of what the preferred return didn't pay on the second year. And if we paid you again 5% the second year, we would owe you another 3% on top of the 3 we owed you. And then that essentially just cascades into essentially your preference. So it's 8% annualized preference for investors where all profits go to investors first. So if we go to 4 years, it would just be another 8%. And then upon capital and equity distribution or a sell, if we're not tendering changing, if you're not opting out of redeeming, or if you're opting out of redeeming, then you essentially be caught up to your pref. If it's 3 years, that would be 8 times 3, 24%. And then above the 24%, that would be a 70-30 split. Did I get that right, Mark? Pretty sure I did.
Yep.
Okay.
Thank you. Cost comparison with neighboring property is 240K versus 204, but rent is half of that property. Seems like we are paying a big premium on this property. I think we've skinned the cat many different ways. Anything else to add on that, Mark or Ring?
Yeah, sorry, was the question about the rent comparables?
Yeah, considering that the rent is half the rent of the neighboring property, aren't we buying this at a premium?
It's not half. It is 40% on 1 bedrooms, and it's 20% difference on 2 bedrooms. We're buying a current B class property at 3.8% cap rate, which is a low cap rate, but we're not buying the current income stream. We're buying the value that we're able to add to this. And with our business plan and execution of that, we will be able to make up that difference. And that's how this is value add. It's a light value add, but it's value add. And those are the challenges that we look forward to.
Why is the owner selling? I think we've talked about it. Anything else that we want to add on that? Okay, thank you. How many full cycles does Tozi Capital have in the Houston market?
We have 0.
This is our first entry into the Houston market.
I have operated properties in Houston, none of which there is on the property management side. I wasn't involved in the purchase or sale of those, but we are familiar with that market.
Thank you. Mark, looking at the reviews of the property online, most new negative reviews are due to bad experience with the front office. In order to get over this negative sentiment or review, will this be rebranded?
We do have the 200,000 for marketing reserve in there. Don't know yet. We haven't decided. I think we definitely did talk about it, and it is a great idea to do. But what we want to do first is spruce it up and make it nicer before we try and make this a Class A project versus other with Maple Haven. When we bought, that was so bad, we had to rebrand it right away. We had to let everyone know this is under new management. So yes, it's very likely we'll rebrand, but we haven't decided for sure yet.
Okay, thank you. I'll just read the question as it is typed. If the time is not right to see it due to the recession, in 3 years, how will the interest-only loan impact the gains negatively?
It's a great question. It's a 3-year loan, bridge loan. So most likely, regardless of what's happening, we would probably refinance into something. Now we're refinancing with potentially a more stabilized, higher market rent style. So there probably can be some equity to be able to pull out. But I guess if you're conflating or saying inflation, recession and inflation and maybe higher interest rates, generally in a market cycle, you will see the Fed increasing interest rates. That will trigger potentially some sell-off and lower investment and more savings, less consumption. That can trigger a recession. And then the Fed will potentially always be lagging behind in their response to things. And so a 3-year cycle is fairly lengthy cycle for these things to happen. These things generally happen more in quarterly cycles, not multi-year cycles. But obviously things could change to investment.
An investor asks, go ahead.
The drop is always quick and then it's usually a long run up. But to add on to that, when we stabilize this asset into something that is much nicer and good quality tenant in there, we won't have a bridge loan. We'll qualify for an agency loan. So if we did have to refi, we would qualify for the best loans in the market, whether it's HUD or Fannie or Freddie.
Want to just highlight that I did say that we don't, Cozy Capital has no experience or full cycle deals in the market. Frankfurter, our operating partners, and the primary asset managers do have 3 deals.
Can you provide a concrete example or link to the accelerated depreciation schedule? Is that specific to this property that was built in a year, or is it something specific to multifamily in general?
Is that
No.
the full question?
Yeah, yeah, that's the full question. I think they were talking about bonus depreciation. It is not something that only Regard can make use of or only multifamily can make use of. Bonus depreciation is a concept in the world of commercial real estate. It's a very generic thing. There are some rules and conditions that apply to that, and you could definitely Google it up. And it's not specific to Regard. It's a very...
And I do have some YouTube videos discussing depreciation and bonus depreciation. I was actually going to create another education webinar on the case studies of how Cozy Capital has delivered that. Several of our investments, like Grand Royale, has delivered 100% bonus depreciation. Essentially, literally, if you invest $100,000, you get $100 loss in the first year, while also receiving cash flow, in your bank account. And most apartment buildings we've averaged around 50% of your investment basis. That's, of course, this can be determined by what the cost segregation study says, but also what your LTV is. The higher the LTV, the higher the depreciation we take, and the lower the land value, the higher depreciation. All in my YouTube videos, education videos.
Thank you so much. Mark, currently the rental market is at an all-time high. Everybody's paying high rents. Are the comps calculated with the current rent? And what does the pro forma look when rents decline? Does it account for rent decline?
So we don't have a rent decline in here because we're adding value to the property. We are forecasting a rent increase. In our presentation, we did an analysis, what's called a stress test, where instead of rent decline, we looked at vacancy. There's definitely room on this for adverse events for us to be able to still pay distributions and recover.
Are we purchasing extra flood insurance for this property?
We're going to be properly insured. We don't have to overpay on flood insurance, and especially because in Hurricane Harvey, there was no water intrusion for that, so we're okay.
Is the income distribution from this property considered a short-term or long-term income for tax purposes?
It's considered ordinary business income. Real estate is just a business. When you sell something, it's a capital gains. But when you operate it and collect rent and pay expenses, your profits or net losses is essentially passed on to LP, limited partner investors. You essentially get a piece of that on a pro rata basis of your investment basis. And so if the investment generates a profit, and we're expecting that in the first year, that profit will be categorized as a ordinary income. Now, of course, because we will have depreciation, that would be offset. So you wouldn't necessarily pay, I would not expect to pay any ordinary income unless you use all your depreciation net in the first year. Although even the second year, we would probably be close to net neutral based on the 27.5-year life cycle or of the remaining depreciation that we can provide to investors. It should typically be around 4 to 5% to maybe 6%, which will likely be around the same amount of cash we would be sent to investors.
And the investor asked, would there be a depreciation recapture at the exit? But of course, it's not true to this property. It's true to any property there will be. Mark, will you be hired?
Sorry, I just want to correct my last statement. There is a sensitivity analysis on rental rates specifically. If you refer to the deck, you'll see that in there.
Yeah, sorry for that. I was just looking at the next question. Yes, it is there. Mark, will you be hiring an outside company for taking care of all the CapEx?
No. So our JV partners, depends on how you look at it. So Frankfurter does have someone in-house who has a construction background. They will be managing they'll essentially be GCing the contractors that we do bring in. So yes, we'll bring in specialist contractors to do the work, but we'll be general or GCing this in-house.
Okay. We have just 8 more questions, so bear with us, everyone who's still listening. If your question has not come, it is definitely going to come in the next 5 to 10 minutes. What happens if there's no sale in 3 years? Will the project still cash flow positive? It cash flows positive much earlier than that. But the question is, what happens if there's no sale in 3 years?
I guess yes, a sale is always, two parties that need to agree. So we can't always determine that we want to sell, especially if we're not getting the right type of buyers. Likely we would alternatively would refinance our loan to a more stable long-term loan, which will allow us to likely have lower interest rate payments and payments overall. Although right now we're doing an interest only payment. So that is something that most investment projects like Stanton Yards is actually projected to do, but we're always going to take the opportunity to either sell where it's maximally beneficial to investors, or refinance or hold. Again, we always try to keep the investors' interest top of mind.
A couple of investors have asked about details on the current rent for the different units at the property. Is that something that is already there in the deck, the current rents, or is that something that you can share now?
We have in the pro forma.
Okay.
And the average rent is $1,270. Looking at now. And then the unit mix is 223 one bedrooms and 96 two bedrooms. So 70-30 split. No 3 bedrooms.
No 3 bedrooms. What is the break-even occupancy rate? Did we go to that?
Based on today's economic condition, which I think is conservative, it's essentially 80%.
Okay. What have been the average IRR and equity multiple on previous deals from the sponsor in Texas? I think it was there in the deck where the exited deals, 3 of them were mentioned, right?
Yes, the equity multiples have been 1.4 to 4.2, and usually within a 2 to 3 year time frame. So our partners are generally pretty good at essentially accelerating their business plan and then selling. And the IRRs have been 25 to 60%. Now, none of those were in Texas, just FYI. So,
yeah, they have 9 exits and they're all over 20% IRR, probably over 25% IRR. So when you see a low multiple on a short hold, you shouldn't put too much weight into that. It's more of an IRR play.
Fair enough. For this property, does the IRR calculation take into account the tax benefits from the accelerated depreciations? If you sell after 3 years, wouldn't the $1,250 depreciation recapture cause a very huge tax bill at year 3?
no, it does not take account accelerated depreciation. If you did, because everyone's tax benefit is different, because some people don't have other K1s that have profits to offset or aren't real estate professionals. So in those circumstances, essentially just offsetting ordinary income, which is taxed at a higher rate. So when you recapture, just to answer your second part of the question, that recapture is taxed at a lower rate, I believe around 25%, different than long-term capital gains rate, but essentially it's transforming, it's doing two things, deferring your taxes, and then also transforming from ordinary income to recapture rate, which is lower rate overall.
Thank you. An investor asks, can the income from this property be rolled over to a 1031 exchange? It's very nuanced because the distribution itself is also an income that cannot be rolled into a 1031 exchange. But during sale, what Eng had mentioned is if the stars align, which means if there is another property in hand and so on, there is always the interest to do a 1031 exchange during sale. It is definitely possible, and that's the intention, but certain things should align.
Yeah, my intention is always to pay as little taxes as I legally can, to invest more of my money, to defer, and then use the stepped up basis when I pass away to have no one hold the bag of taxes. And as an investor in this deal, investor in all deals, I want to make sure that investors and myself get all the benefits legally provided in tax code. So if I'm a long-term investor in American real estate, I have been for quite a while, and I will continue to be. So hopefully the stars align. That would be the initial intention. Of course, we're not going to overbuy or do something that isn't fiduciary responsible, just so we can defer taxes.
Okay, I think we have a few more questions, but these are new questions coming in, so otherwise it'll just keep on going. I think I should take a cut at questions that came till 7:15. Plus, I'm also seeing those questions are questions that investors can ask you directly as well. To the investor who joined really late, yes, we talked about the bad reviews on Google. Definitely look into this recording to hear Mark and Eng's answer on how they're going to handle it. The question was, what is a K1? I think that's a very broad question, but I think you can just take that up quickly because it was asked very early.
Yeah, it's a end of year tax document. So if you invest in E-Trade or you have like capital gains, you're getting a 1099. For limited partnerships, the 1065 form, and what we colloquially call a K1, that will essentially highlight your portion of the profit and loss. And that profit and loss will have significant loss in this case. But if in the case where we don't have depreciation in the second year, we'll have a gain. And then you can file that because we did not have any withholdings, because we essentially pass all the distributions, pass all the income to investors pro rata. It's essentially an LP passing to investors pass through.
So thank you so much, Eng and Mark. That's the end of questions that we have. Thank you so much to everybody who stayed back and to all the questions. As always, thank you so much to all the repeat investors who have asked questions and who have asked the hard questions as well. Thank you so much. Before we close, I hand it off to Eng for his closing remarks.
Thanks, Shiv and Mark, for moderating and helping present this great opportunity to invest. I really like that we've been selective with our real estate deals over the past year. And this deal, I think it's an easy business plan. I think it's mostly just fixing a lot of the issues, low-hanging fruit. And our partners are especially suited to do that. We're trying to build a community that essentially rises to the level of what the future tenants could be, which is in this medical center community will be significant and very, very healthy economically. I appreciate everyone for attending on Tuesday evening, for all making it hour 35 plus minutes. And thanks again for your time. Thanks, Shiv. Thanks, Mark. Thanks, everybody.
Thanks, everyone.
Thank you so much. Bye-bye.